enough for you. So I put a question mark. It means I need you and me, we're working together, see that's okay or not. So if you're not okay, we can postpone to another one. So that's said this way, okay? Today finish chapter 5, and then next class chapter 6, let's say, and then following week on March 9th will be chapter 7 or chapter 6 half and 7 half, and then March 11 will be 7 finished, okay? Then we have a review March 16, then 18, but 18 I have an exam. Or you could have exam on March 23. Okay, so that means I'm putting here, March 23, okay? So we are debatable, okay? So we'll leave it there for now. Just say, unless you have said which days you cannot do it, somebody, if you have some idea, you let me know up front, okay? So before I arrange the time. Once I make announcement in the Blackboard, that will be becoming settled. So right now it's open mind thinking, say timing schedule around March 16 or 23, okay? So that's the other one is 23, that one you have weekend. So we will see. So far leave there. All right, so let's go continue our last time, okay? So we did before here, like that's why on purpose stop here. Before this piece of money supply demanding, we had a bond market supply demand, okay? So we did a very good analysis on bond market. Bond market relative makes sense because you learn how to invest on bond, okay? You know you want it or not want it based on the price, all right? So therefore, use the bond market is a good idea to do that, okay? So then you have let me do that, okay? So supply demand just based on price, okay? Based on price. So that's what we did very well, okay, bond. But now is we wanted to introduce money supply demanding. So that's a little difficult, but you have to follow me, okay? So here is, we use the Keynesian model, okay? Keynesian, what he trying to say is, okay, in this world, we have too much noise in this world, right? We have gold, we have Bitcoin, we have so many things. Just we have nothing, okay? In his model, he said, make things simple. There's nothing else. Only have is money and the bond. Okay, the bond market, right? So you have the debt market. So only bonds and the money, nothing else, which is good. Make life simple and easy to be analysis, okay? So if in this Keynesian world, only have two assets, either you hold the money or you hold the bond, right? The security bond, right? The corporate bond or municipal, just one bond, okay? Only that. So if in that case, so our nation wealth is money and the bonds, all right? That's it. So that means overall in our nation, okay, total wealth in the economy must be bond supply plus money supply. Remember, in our society, only supply the money and the bond. So then the other side, the people must be demanding and the money and the bond. So therefore, they must be equal in your society, in this nation. Let's say your society is your family member. If some person buy the bond, some person must be selling the bond, right? So that's inequity market clear. What do you mean sell? Remember we said, if you want to offer too many bond, it's not good price, nobody buy. You couldn't sell means no market, okay? So therefore, bond supply plus money supply must be equal to bond demand and money demand. Do you agree?
Yes.
Good. Yes, okay. It's because in the society, nationwide, everything cleared. So somebody selling bond must be somebody buy. Otherwise, you couldn't sell. Nobody buy, then you just didn't sell. So that means not supplied at all, because in your inventory, no matter what, it doesn't matter. Didn't affect the society. Okay, so must be clear. So supply bound under this one. So that's why this equation equal. Okay, holding. If it is equal, you accept it. That's easy now. Okay, move the equation, say, okay, all the bound put a bound side. So that means bound supply minus bound demanding should be equal to money supply minus money demanding. Okay, so just organize this equation, nothing changed at all. Okay, you accept the first one, second one, you accept it. But remember, we say market clear. Clear means in the equilibrium, means not over supply, not over demanding, everything in the equal, right? So that's, it take a while, you will market in equilibrium. Okay, if in the equilibrium means supply bound, how many they supplied should be equal to how many demand. So equal, so they're equal, so that means zero. Okay, so then same thing, if a bound market in the equilibrium, so then bound supply equal to bound demanding, then this equation equal to zero, then money should be same, equal to zero. So if equal to zero, that means supply, money supply equal to money demand. Okay, that's the follow. So not done yet. Our job is to get the money supply and the demand curve. Okay, we only understand this piece, but always hold on this thought that bond and the money only in this economy. Okay, nothing else. So then follow me. Okay, follow. So just follow demand and money curve. This is a very important piece, very difficult. Okay. So don't look at anything else. Just look at money demanding curve. So then this vertical here is interest rate. Okay, remember bond is the price. So here's interest rate. Okay, so follow this. Have the thing, borrow the thinking. Okay, so that's interest rate in the top is high, right? 8 point interest rate is 25%. Okay, at the E point interest is low. Okay, now let's argue a little bit. At this 25% interest level, okay, compared to 5% interest level, which bond price is lower?
At 25%?
Thank you. You're both right. 25 at this one, right? Okay, good. At this point, 25% at 8 point, bond price is lower than this 5% at the E point. So if bond price lower at the A point than E point, so bond demanding will be higher and lower at the A point.
It would be higher.
Thank you. Right, you agree? That's say follow logic. At this point, interest is very high, so bond price must be very cheap. Okay, because the bond is very cheap, so then people want to buy low, selling high, right? So that therefore people they all buy the bond, right? Okay, so bond demanding will be increased a lot. Okay, so in a society only have bond and the money. So all the money go to bond market. What happened to money demanding? High or low?
Low?
Thank you. Yes, because you're in the old nation, most money go to the bond market because bond is so cheap. So demanding of the money will low. You can see at 8 point only 100 billion. Okay, compared to E, let's go to E, argue again. At the E point, the interest is very low compared to 25%. Okay, so bond price high. Because the bond price high, nobody want a bond. Remember, in your society have nothing else. If no one do not want a bond, then must be in the money, right? So that means must be people buy you holding the money. Yeah, only two assets, either bond or money. But nobody want a bond at this point. Must be a lot of people hold the money. So therefore, money demanding at high, say 500 billion at here. So follow my argument, okay? Without this argument, you cannot get a demand curve. So therefore, you get demand curve. Let me repeat again, okay? So interest rate, okay? You use the bond, the moment is the price here, bond price, and then you have to convert it to the interest rate, right? So here is interest rate, for the money we wanted to analysis. So interest rate in vertical, Okay, so from 0 all the way to high. So we choose one point. We just choose a high interest rate versus lower interest rate, okay? We do know higher interest rate moment, bond price must be low because they always have inverse relationship. So at this point, 25% interest rate level, bond price cheaper than interest rate at the 5% level. If the bond price cheaper compared to this 5% moment, then the demanding of the bond, you and me will be happier buy at a cheaper price. So therefore, you and me, more people want the bond, cheaper bond. So low by low at selling high. So demanding bond high here at this point, at A point. So if we all the society only have money and the bond, we all put the money in the bond, so demanding for money will be less. Therefore, only 100 billion dollars bond money compared to at the E point, which many people at the interest low, bond price high, so that nobody want a bond, so that a lot of cash we hold. So that's why I have 500 billion demand money. So we got 2 point, we got demanding curve. Okay, follow me. So, okay, good. Once we got the demand of the money downward curve, that's easy. So that's the money demanding, okay, follow. Interest lower, demanding money is more, okay? The demanding curve. Supply easy for us.
Wait, Professor, I have a question.
But, yeah.
So if the x-axis was quantity for bonds, the graph would look completely different?
Yeah, it's different because for the bond, here's the price in the verticals here, right? For the price. Remember? So let's go. This is for the dividing the money demanding curve. You have to thinking about the bond because society have the money bond. Let me go to the bond. Okay, remember bond price, right? The price then demanding supply. Remember what's your vertical those x you use. Okay, so we use the bond supply demanding curve. Remember, then we also borrow the idea Keynes model. Means in your society only have money and the bonds, nothing else. Then will be easy for you to analysis why demanding curve is downward, because you do not want the money, you must be put the money in the bond. Okay, so that's why in this case people want the bond, then don't want the money. Okay, so in this case people that want the money don't want the bond because bond is expensive. So then this one link to becoming downward demanding curve. Okay, so we derived the money demanding curve. So that's borrow the idea, borrow bond market, then we can get it. Okay. So we got demanding curve. Then vertical, like I say, money supply is not you and me. Nobody can supply money. Nobody. So it's the Fed. It is our government supply money. That's how Fed decided to put how many $1 billion in the economic system. Boom, vertical. Just put in there. That's why nothing affected. It's arbitration they put on. Of course, they do research or whatever. So they put money supply. Immediately figure out what's interest level. You see? So why our Fed keep interest very low? Because they put the money there, make it low, right? So you can see if they put a vertical in here, they make interest low. Right now it's almost zero, right? So they put the money supply, that's why interest is low, because they decided how much money put in so that interest rate can reach the level they wanted. They wanted interest rate becoming like 15% in here, equilibrium. So they use money, demand and supply. Okay, demand like we analysis, how we got a demanding curve. Supply easy, it is the Federal Reserve Bank and put it in there. $300 billion, put it in the economic system, boom, we figure out what's interest rate. Okay, now we have an interest level right now. Okay, so that's easy, right? So in the equilibrium, so key point here, we derive the demanding curve and find out equilibrium interest rate level. That's what we go closer right now, closer to the Fed decision right now, okay? So let's see what happening to the shift maybe, okay? But first thing is, what's other information here, okay? Demanding for money in the liquidity preference framework. remember we demanded money versus of bond, okay? So how we demanded for money, see how they interpret here, okay? So as interest rate increases, follow, okay? See whether you agree, okay? Increase going up, okay? So opportunity cost of holding money increased. Somebody tell me why. What do you mean opportunity cost?
Because if you had invested that money elsewhere, it would be earning interest.
Right.
So any money that you have on your person in cash is not earning interest. So that's your opportunity cost.
Exactly. For example, you go to college right now, and you in the future you're going to make a lot of money. If you didn't go to college, you maybe have trouble to be rich. Hypothetically, you still can be rich, right? So, however, opportunity cost. If you didn't go to college, you have opportunity cost because you have potential go to make a lot of money, whatever. So that's opportunity cost. He gave a very good example. Yes. If you hold a cash, just for example, you put the money under your mattress, okay? You put the money, you say, I have cash, I'm so rich, I'm good. But you put it under the mattress, in your home, backyard, buried, hiding there. You didn't put the money in the stock market, hypothetically. So market every year, that's going up for 7 years, 10 years right now, and you have opportunity cost. You didn't use your money to make more money. That's the opportunity cost, okay? So here's a very good example, say, if interest is going up, okay, you still holding money pay you nothing. Money do not pay you interest rate. Money cash, okay, let's refer to cash. Now say deposit money in, well, deposit account also don't count that much interest, so little, right? You should use money to something else. So interest is going up, let's say you buy dividend stock, or buy some high yield bond, whatever, just interest going up, everything going up with it. You didn't, you hold the money, and that's opportunity cost. Otherwise, you can make money. That's what I mean, okay? Very good. So next one, so relative expected return of money, because money holding cash, everybody else assets make money go with interest rate going up. So you holding money that return, of course, not making money for you, because your money interest going up, everything else make money, you didn't, you lose the opportunity, and you're holding money that relatively reduce the return. Actually, don't give the return at all, you don't more interest, but relatively reduce your money return, okay? So then what? You don't want it. So interest going up because interest going up, opportunity cost, that's why you don't want money. So therefore, see here, you can do the same thing. When interest is going up, who want the money? So demand less, right? If we're going higher, nobody want to hold the money because you have opportunity cost. Why don't you use the money? Interest so high. Why you put anywhere can make a lot of money in interest. So you should not holding cash. So when higher interest rate moment, you should. So that's why nobody want to holding cash. Your opportunity cost from that angle, you can still get that demanding curve, okay? So we use the bond, borrow the bond idea, easy to analyze. You can use this opportunity cost, you also get that vertical, okay? That demand curve. So therefore, the quantity demand of the money decrease. That's why, because the opportunity cost, that's why demand curve downward, okay? Same, we have two set of analysis. Once use bond, once use opportunity cost, same thing, you get the same thing, okay? So this is a liquidity platform. Okay. Because why? Because your money didn't generate anything, right? You're holding something else, that's a holding dividend stock. You will have the high interest rate, and the interest dividend will going up with it. So your stock rate of return, relative money didn't give you anything. So relatively, the money will be giving you lower return. You expect return. You don't expect any return anyway. Can you anybody tell me money can generate a return? Money don't pay your interest. It's cash sit on there. So relatively compare other assets booming, make money, high return. So relatively, you're holding money have the no return at all, basically. So that's why relative decrease means the relative, the other increase, this one relative decrease. That's why relative, okay? That's why money expected return is decrease, okay? So, all right, for about this, the other one, right? So what about this? Let me go this one. Okay, so that's a liquidity frame, right? So next one, change in interest equilibrium, right? Let's see what happened in the liquidity frame from how we shift, okay? Follow, what are gonna shift? Shift in the demand for money, okay? That's the income effect. Let's see you agree, okay? Income effect means that's here trying to show higher income, right? So if we all get a promotion next year, or we all get a minimum wage, remember we had minimum wage increase, that means our income definitely will increase, right? Let's say, so higher level income. Okay, so higher level of income cause the demand for money, right? You okay? You agree? Okay, because you're rich now, so you have more money, you have more income. Before in your pocket, you put a $20 as everyday deposit in your pocket, just if you want to buy something very easy to convenient to buy, right? So now you're rich now, so $50 put in your pocket, okay? So that's why you want more money, means you demand for more money. You at any means doesn't matter which interest level, because your income, in fact, you increase your income, okay? So that means income effect will shift the demanding curve to, you agree, to which way? The money demanding curve should shift to where?
To the right.
To the right, demanding increase shift right, okay? So now remember, the income effect shift, demanding money shift to right. Okay, let me say this again, okay? Let me go this, use this chart, where's the, hold on. Okay, see? Okay, so that doesn't matter which point, at any interest level, because our all income increases, so demanding curve will shift to here, okay? Shift to right, because increase demanding, okay? Because we all increase the money. Next one, price level effect. So let's see. So price level means price increase, right? So rising in price level. I want somebody to tell me why. So why price level causes demand for money?
I think a price level effect, an increase in price would be that there's more inflation, so money could buy less things. So people are going to need more money in order to, pay for the stuff
Yeah,
they used to pay for.
very good. Yes. So that's why shift to right. Right. Okay. Very good. It is true. Okay. Because when, let's say you buy laptop, okay, before you buy laptop 1,000, okay, just because of any XYZ information, could be anything, or could be oil price increase, could be anything cause this price level shift upward. So once you shift, you cannot $1,000 buy a laptop anymore. You had to pay 1,500. You need the extra 500 money. So you demand more money. So this outside factor, that's why shift to right. Okay, so that's good. That's a very good analysis. Okay, so that's price level, shift to right. Okay, another one. So what's this one? Okay, well, okay, very good. So now we're down the demanding shift. Okay, let's say supply. Okay, supply, of course, like we say, it's not you. It is a central bank, okay? So central bank is our Fed, okay? And like I said, it's your job to make decision, because we are the supposed to be this course about the Fed chairman, Federal Reserve Bank, and what they do. So supply money is controlled by central bank. It's the Fed make decision. So they put the decision about how much money put in. So they will make decision. They make a decision more, they shift right and make a lower interest rate. You saw that curve, right? So the Fed make decision. They want the interest lower, they put more money, okay? They want the interest high, they put the interest going high, they put less. Okay, and then you're gonna learn very soon. You're gonna learn how they operated this operating process, okay, open market process money to manipulate this interest rate movement. That's what you're going to learn very soon. Okay, so that's supply. Okay, so then you cannot handle it, right? So now they give you example, summary about this, right? Income effect. So like we say, okay, if we all income increased, so demand money will increase. So the curve will shift to right. Okay, the demand of the money curve shift right. Therefore, watching, I forgot to ask you this one. When they shift to right, so what happened to interest rate? If nothing else changed, only demanding for money increased, the curve shift to right. What happened to interest rate?
Nothing.
Look at chart, look at chart. Look at chart, how it shift. See, look, from demanding,
Interest
right?
rate decreases.
Look, watching, hold on. The blue is before equilibrium, okay? So demanding curve, blue, vertical is a Fed put in, the entry level in the I1. You know what, I do this. I'm go to this chart, okay? So, okay, so this is the bond market, okay? Now, if it's not bond money supply demanding curve, I put it in here, or just follow me. And you have a vertical here, okay, money is like this. You have demand the money, it's downward, but vertical, it is the supply, okay? So this is vertical. Okay, so before already in the equilibrium. So this is in the equilibrium means money, okay? So at this I is here, interest rate level, put I here. Okay, this is interest rate, okay? Interest rate. And this is the quantity of demand for money, Q, okay? So we are in the equilibrium. Suddenly, remember our income increased. You say is demanding curve will shift here, shift right. Okay, so let's say if we shift right. So this interest rate before equilibrium. Okay, this is I here. So what happened to interest rate after this shift?
Interest rate increases.
Yes, increase. Now, okay, now you know interest rate going upward. Interest in here now. Okay, so going up now. So what I mean, that means when the money, demand the money, what happened? Why we have demanded for money? Because income increased. Our national income increased. Therefore, demanding for money increased. Therefore, interest is going up. Then do we just argue right now, society right now, everybody argue about a $15 minimum wage arguing, and also arguing about income increase, interest going up. Go ahead, Sean. What's the question? Okay, he's gone. All right, so that's why interest rate. Okay, so that means our nationwide interest rate going up, our money, demanded money increased. You can see that our income increased, the interest rate will going up. And right now we do have a possible, the interest rate going up, have many considerations. Could it be inflation, right? Remember? And then price level, you also have this shift to right. When you shift to right, interest rate going up as well, interest rate, okay? So that's what we say could be effect of inflation. All right, so that's why you can see, this is a curve, okay? This is curve. So income effect, and this price level effect, the same thing. They both result ending is interest rate going up, okay? So money supply is vertical. If they put more money supply, see, to put the right side, okay, let's shift the right. What happened to interest rate? If we in the equilibrium, suddenly the Fed wanted, yes, going down. So the Fed wanted to increase, put more money, say interest rate going down. You see, the other two is going up, and then Fed put something, make it down. Now you can see this conflict, so where it is. So that becoming anywhere. Okay, let's see. Okay, so that respond to change in income or price level we just did, okay? Before in the equilibrium, okay, and then suddenly we have income effect, means income level increase or price level increase, or shift demanding money, shift the right side. So interest going up. So now we know income could be affect interest going up if income going up and all price level. So that's why everybody anticipated that right now interest rate could going up. Remember a couple of days ago you saw bond market so unstable, and yesterday bond market stabilized, market so happy. It just totally people panic about this, what happened. Okay, go ahead. By week, you want to buy the VIX, the stock volatility? You want to bet on that? You guys really brave. I'm a long-term investor. You're betting on VIX, you know, also have 3 levels of those. It is risky though. You can play, but it's not really investing though. You can play, yeah, but it's not. That's volatility, betting on volatility. Oh yeah, but you think volatility going to be like this high? You never know. Because
I think once, because the Fed, I don't think the Fed could stop. I mean, they could stop interest rates forever, I guess, but then they would really be printing a lot of money.
yeah,
And I think there'd be a lot of backlash.
yeah,
Like,
but okay, but here's the case: volatility go both ways. Means you want you see market now now stabilize, stock market now stabilize, means it's going to be up down. You do not know. If you betting on you buy VIX, that means you betting on volatility. You means the market can be up down, but they can go one direction. You know what I mean? They can say everything's bad, right? And then the market just going down, never going backward. Then volatility also low. It means so volatility should be move up, down. This couple of days is pretty much bigger, but it's still you see VIX 23, so it's low. One day being like,
oh, actually, I'm talking about a different VIX. I'm talking about the ultra short
That's
UVXY, which is even worse, I guess.
yes, don't back in that.
Yeah.
No, don't back. That's very risky. That's triple times. If
Yeah.
they down, you down triple time. If up triple time. That's gambling. That's gambling. Yes, that's really not. We're investing. We're not gambling. So that's risky. Okay. Yeah, I know what I mean now. It is more risky, that one. Okay. So here is the risk by income and price level, right? So that's good. We know the interest rate. I'll go next one. So response of this change of supply, that's the government, Fed put in, so lower interest rate. Okay, so when Fed put more money, if market in equilibrium, Fed put more money, interest rate from equilibrium and lower. Okay, interest can be low. So that means you can see the other two effect going up, and then Fed can put it down. Then what if all in? Okay, let's see, because things in the real world is not just oh, this one not happy, hypothetical, that one not happy. No, in the real world, everything all happen all information in there. So then it will happen. Okay, so that what we'll do now, we're gonna figure out what's going on. So that's becoming complication. Okay, let's see. So price level effect and expectation on the inflation effect. Remember, you see what we just did. Once we saw the Fed put the money in and then interest going down, but you and me already see it. We have expected on inflation. We have thinking. So now becoming complication. Okay, we'll see that. So a one-time increase in money supply. Okay, normally we know it's just one time we have an oil shock, just one time. Then that's it. It'd be okay. It means like just a price increase or price level adjusted. That's it. Oh, we have one time in minimum wage adjustment. That'd be fine. Okay. But if we have ripple effect, that's called inflation. If it's just one time, it's not called inflation, just called price adjustment. Okay, that's it. So now I'm going to tell you, okay, so one time in money supply will cause the price to rise to a permanent high level, and that's it by end of year. So that won't cause inflation, okay? So next one, price level effect remain even after price have stopped rising, okay? So that means price level remain there, high level, even after price have stopped rising. Okay, price not increased, but the price level stay. That's okay now. So now we see if other that are going to be inflation, okay? So a rising price level will raise interest rate, okay? So price going up of course, interest rate will go in, we worry about inflation. So expectation also there too, will raise interest rate because people will expect it, right? So that's what we worry. Okay, so expectation built in. Remember the Fisher equation, interest rate, real interest rate plus expected inflation becoming equal to nominal interest rate. So when Fed put more money in there, we immediately feel interest rate increase because inflation there. We have expectation there. Okay, so expectation inflation to be higher over the course of the year. So over the period we know. So right now exactly what we price in right now. So when price levels stop rising, expectation of inflation will return to zero. So when price increase 1 times level, then we don't expect the Fed going to be printing money. We don't expect oil price going to, nothing else going to affect it. Then inflation, we only expect that next year will going up. We don't. So expectation of inflation, we stop it. Okay, it means zero. You don't have expectation. So our expectation, totally looking at the future, what's going could happen that way, right? So if nothing happens, then we say no expectation. So the expectation is very, very important. So Fed always give you confidence after they talk about it, what are the decision about the interest rate. They want the public to meet their expectation on expected inflation, because they want the public all in their steps how to going forward. They want their inflation, our inflation, built in with their planning to do. Okay, so it's very difficult to manage public expectation. Okay, so expected inflation effect persists as long as the price level continue rise. So you saw Zimbabwe, whatever, those hyperinflation, just because they keep going up, and then you keep going up inflation, then people will have higher expectation, then come result going to be higher inflation. So this is becoming never stop it. Okay, so that going to the hyperinflation. So you have to stop it and make people don't believe we're going to have inflation, then don't price in. See, for example, right now market, you see the gold didn't going up that much because even though we know future could be inflation, but nobody see current right now, this moment will be. So expectation on inflation stop it. So that's why gold didn't shining now. And then the TIPS, inflation protection, that one didn't shining now, means no inflation expectation. All right. Mm-hmm. Yeah, that's already silver, copper. Yes, they already high a lot. Commodity high because they already price. Yes, they already see that's what the market before pricing in the inflation already. So, but right now to the point is whether it is a bubble. People are starting to talk about bubble there, you know what I mean? But still maybe have the room to go. You never know. That's why they're watching out this policy. Because when we finish this stimulus, right, the package, COVID package, then whether they have a stimulus package, whether they have other money there, whether the Fed are going to be twisted or quantitative easing, we do not know. So a lot of things people are watching. If it really become a bubble in the commodity is really high right now already. People are already moving, very early, a couple of years to starting already doing that. So yes, so you have watching right now. Nobody dare to say right now it is a peak, the moment. It's a high a lot, yeah. Mm-hmm. They wanted, but they still wanted to, they didn't see inflation. They still wanted a little bit of inflation under 2%. We don't have it. Well, they have two, CPI, CPE, but it's not only just that indication. You have also, they project the future, what could it be? If the tax increase, a lot of things, factors involved it, whether they should put more. Right, so then the money depends on a lot, yeah. Okay, so that's the price level, right? So let's see next one, inflation. So that's a higher rate of growth of money supply, lower interest rate, Remember, we have that before. Money grows. Okay, the higher money grows, the more we think the more money we put in grocery higher, well, our GDP will go with it. Remember, so now we want to see whether it is a lower interest rate. So okay, watching liquidity preference. We just did a liquidity preference framework. Okay, lead to conclusion that increase in the money supply. Remember vertical, lower interest rate, right? Remember vertical, this is the one, this one, okay? Increase liquidity means increase more money. If you put more money, interest is going lower, okay? So that's what the liquidity preference, okay, just showing you. Okay, lower. So income effects, we'll find out, we said, we know interest is going up, remember interest rate rise because increased money supply is an expansionary influence of the economy. Let me tell it again. Remember, when the market, the Fed put more money in the economic system, what I mean? That means they want the economy booming. They want lower interest. Why they want to lower interest rate? Because so you and me, a business can borrow money cheaper, so they can do business. For example, you want to open restaurant. If a lower interest rate, you will want to say, oh, you know what? I want to go to open restaurant because the interest is so low, I can borrow. And then my revenue from the restaurant can pay those borrow covered, and I still make money. So many people do business will be like that. That's the whole point, right? That's why the Fed want a lower interest rate, because they want an expansion. So that's the whole point. So when they put money expansion, okay? So if it expands, influence the economy, right? So however, income effect, you and me have a high income. We remember we make interest going high, remember? So then Fed put the money, make interest low. They want expansion. You saw the conflict right now, okay? So now continue. This is all trying to tell you what happening if we all have the same information. You and the Fed, we all have same information. What happening to interest rate? We have some interest going up, some going down. Andrew, go ahead. Okay, so let's go next one, right? So price level effect predicts an increase in the money supply, lead to a rise in interest rate. We know that, okay? So it's bound to rise in the price level, we just did. So price level, income level, all shift the interest going up, okay? It's expectation on inflation also shift increase interest rate, okay? We know that. But the Fed make interest lower. So now watching. So my question is, what could be the interest rate at the end of the day if all these expectations, all the actions happen simultaneously? So watching here, okay? So you do not know, means you do not know, nobody know. So here is now you're very sophisticated, now just one direction now, okay? So let me make this bigger so you can see clearly about this argument. This is a very important piece here. What happened? Had to go from beginning to the end? Okay. Okay, I just wanted you to see the bigger one. Do I passing the? No, I'm not.
No, slide 29.
Yeah, okay, thank you. Okay, very good. So now you can see it, okay, watching. So this is still small, right? So let's see. So interest rate, okay, vertical interest rate, okay. In the beginning, we're in the equilibrium, I1, okay, this is I1, okay. So we're in the equilibrium, okay. So remember liquidity effect, okay, which just means like, we have the more money and in this economic system, okay. So that's a Fed take action, put more money in the system. So when Fed put more money, interest should be low, okay, to drop, okay, interest dropped. But remember, when Fed doing that, we all have the information now. We say, oh, Fed put more money in, inflation will coming. So our expectation on inflations, price levels, income, those effects all kick in. That's our reaction. So all kick in. So society, okay, Fed doing this way, our reaction this way. So end up, we do not know who is stronger, means who have strong power, puts interest rate overall higher or lower. In this case, put lower because Fed is stronger than us. So that's this one showing you never fighting with the Fed, right? Fed is bigger. They put trillions of $1 billion in the market. They definitely want interest rate going lower. Then you cannot fight it. We all push up, but that's not high. So at the end, the equilibrium is interest rate from I1 to I2, interest is lower. Okay, so that one result could be. Okay, so next one. So you see equilibrium in the I1, okay, interest in this level, okay? Then at the equilibrium, then suddenly Fed have a liquidity effect, lower the interest rate, okay? But we have income effect, price level, they all put the interest going upward. Also have expectation on inflation upward too. So we are too strong than the Fed. Maybe Fed didn't put enough money there. So then end up the interest going higher. So interest going to I2, so higher than I1. So could be end up this result too. Okay, that's why Fed manage interest rate so difficult. Okay, so next one. Right now, Fed want interest rate, you know, that higher, they want a little bit inflation. They didn't get it. For years, they haven't get yet. So because the market and the Fed totally do the different thing right now. Okay, so beginning interest rate at I1 in here, equilibrium, okay? So Fed want to do the liquidity effect, didn't even buzz, means didn't even affect the economy. Our effect, income, price level, everything much better than Fed doing, didn't even give a buzz, didn't even lower at all. So immediately going up, just like right now, right? Right now, just a couple of days ago, you saw the bond yields keep going up. Just Fed say no, because the Fed do the other direction. But the bond market ignores, say they feel it's not this is 1.9 trillion is not a good idea, going to be cause ripple effect on inflation. So what happened? You see market bigger than that, so totally going up. So overall, give you summary, say that's why it's very difficult. Where is the interest rate can be? Okay, interest we do not know because depend on all those factors all in, you do not know what could happen. All right, so that's why overall interest rate is difficult to handle, and that's you can see the difference. Okay, so this is just final the chart showing you our money growth. So we try to money growth, the Fed trying to put money more or less to affect the market, the interest rate, and this one the nominal interest rate is nominal interest rate. So now you know how interest rate they try to influence this market, use interest rate, use money supply. Okay, so this is chapter 5. We done this. I'm go chapter 6. Okay, so okay. So chapter 5 relatively easy, right? So now chapter 6, well, more easy. I think because the difficult part is how you derive this money supply demanding curve. Demanding curve difficult, supply easy. And once there, you shift easy. So now we go to another one. So risk and the term structure of interest rate. Term structure of interest rate, if you learn bond market, you're familiar with this word. Okay, term, it means maturity, right? The term period is 3 months, 6 months, 10-year term. So those different maturity have different interest rate, okay? Then link to what's the risk linked to those term of those interest rates, okay? So I will show you very soon. You should be able to see in the Wall Street Journal that curve, but I couldn't, I didn't open it. Now I know what once I have on the June, I cannot open it, so difficult. So I'm showing you this again. I join it, okay? So I joined it before to you, but that's important. Once you do analysis on the bond market, it's a midterm. Okay, I mentioned that asking you what we're gonna do. Okay, so the curve. If you go Wall Street Journal, you can see this curve. Okay, so normally, I say normally, you will see that in the future we arguable. So this is a yield curve. Okay, so this is yield. Remember yield to maturity. Yield to maturity. You have maturity related. So this yield is linked to this maturity. For example, this is 3 months. maturity bill, for example, T-bill, okay? And then you have 5 years. Okay, this is 5 years, longer one, and a higher interest rate, okay? So this curve, let's say this is 30 years. So different maturity days have different yield level. Let's say in general, it's like this. So this yield curve, this is called yield curve, okay? And this yield curve called term structure of interest rate, because this term, 3 months, 5 months, means different maturity called term. And then different maturity have different level of yield, okay? Different level yield, okay? So normally they use 10 years minus 2 years, what's the spread movement, and then people can try to use as a signal of the market trading signal, okay? So anyway, this is the yield curve, this term structure of interest rate. So different bond, this is what I just said, 3 month, the treasury security means government treasury bond, okay? Now, if your GE bond will be like this, right? Because GE more risky than this one. Let's say you have a GM right now better, maybe like this, okay? So different corporation, because the AAA, AA, triple B, the rating agency give you whole point is tell you who is safer, who is risky. So if you want high yield, then you go to the high level. For example, this is junk bond, right? High risk, always called speculation bond, so junk bond. So that's high, give you high yield. You know you take a risk. You take a high yield, you're greedy, so then you take a risk. And then this one's lower yield, then lower risk, treasury bond. Okay, this is the term trial interest rate. So we're going to talk about those risks. What's going to associate with those, okay? So a little bit deeper. Okay, so let's see. So bond is risk structure of interest rate, right? We just did showing you that bond with same maturity have a different interest rate due to default risk, liquidity tax. For example, so bond with the same maturity, like I just showing you, same 10-year maturity treasury bond versus the same 10-year GE bond, you just saw it. So the yield different. All right, let me go back again. Let me type in this name again. So this is, let's say this is treasury bond. Okay, they all refer to 10-year maturity. Okay, so this is T bond. So that means treasury bond, okay? And this is, let's say GE bond. GE right now getting better from the worst, okay? GE bond. So GE obviously can default, treasury bond don't default. So the difference here, you see this different? This is pricing different, a lot of information here. Could it be default risk? Could it be liquidity risk? Could it be anything just because GE different? But same maturity, they both 10 years, but yield different. Why different? Because remember we say risk trade-off. This is high risk compared to this one. That's why I give you a little bit more yield. So then people buy it. Let me ask you again. Let's say GE 10-year, GE bond, 10-year maturity, they say both 10-year, okay? 10-year maturity give you 5%. They all selling apart 5% coupon, same equal to yield to maturity, right? Versus T-bond, also 10-year, and they also give you 5%. Also give you 5%. You will buy which one? You buy which one?
Yeah,
T-bond.
T-bond.
Yes, you buy T-bond. Nobody wants GE, right? Exactly. So because this situation, therefore GE cannot sell in that bond, means GE cannot raise money, raising capital, raising funds. They cannot do their business if without money. So they have to do more. Let's say GE know they are not a treasury bond. Treasury bond right now over 5, selling at a par. GE say, okay, I'm selling 7. Now you see yield hunger. Those people will say, I want a GE because the treasury bond, just like right now, you know what? 10-year treasury bond maybe give 1.2. For 10 years, each year give 1.2. And right now, GE give you hypothetical, give you 4. So people go to GE. That's why people chasing yield. People go to take a risk, but people want a high yield. Who want a 1.2% for 10 years? Nobody want. That's the problem, right? So that's why they give you high. So that's why, this high give you information. They give you inside have liquidity risk, have default risk. But if a municipal bond also have a tax consideration, all pricing in. That's why the yield have information there, tell you why that yield high or low. Okay, so we saw this chart before. Now repeat it again, right? We did read it. We said high, the top highest one yield. Okay, this is yield to maturity annual yield. The blue one is triple. Well, it's triple A in the different rating have different name, but a triple A bond, okay, corporate bond, still good bond, high investment grade bond, but the highest yield compare others government. So our government always can tax you, get a tax revenue to pay the bond, always can be, or print money either way. Okay, so that's what it is government. That's why relative safer. They cannot default in general, right? So corporate bond AAA is red one, and this last to be AA means less than AAA. So that's why in the blue on top level yields the highest one. Okay, and then the still corporate bond red, but it's just high quality, and then go government long term and the government short term. You can see.
Professor, can I ask a question?
Go ahead.
Well, so in this chart, according to what you drew before,
Yeah.
you showed that the example that you gave, that the T-bill was better because it was less risky.
Yeah, because don't have a default risk, and this one has
right.
default risk.
But on
right?
this, on this new graph,
which one?
what
Is still here?
the one you just showed on the
Oh.
PowerPoint.
Okay, go ahead.
Yes, on this one, all even the yields for the more safer bonds, like the U.S. government long-term bond, even they are shifting as much as the more risky bonds.
Compared to who? Though? You have to compare to who?
Well, so the corporate BAA bonds and the U.S. government long-term bonds are shifting very similarly.
Oh yeah, that's another phenomenon. Remember, they're moving together. Interest rate, we're going to learn that too. Okay, interest rate, we have next couple chapter, we're going to learn. They moving, did you see that they're moving together, the trend? That's what they're trying to say. Or you're trying to say they are moving together, even though the blue is on top level, so lower quality corporate bond on top. But then red one, it is a second level triple A corporate, and then you have government. So yes, they're moving together. Why? They always like that, moving together. You will learn the theory. That's how we interpret why they're moving together. However, remember here's a problem. When we have this, remember here's oil crisis. That moment we oil dependent, so oil price globally going up. All the price going up, so all the interest rate going up. It doesn't matter your government bond, your corporate bond, everybody going up. But still, even going up, still the corporate had to be higher than. Here's the whole point: is corporations, the lower quality have to be higher than the treasury one, because they have this difference. This difference is the default risk. The higher moment, even more default risk possible. However, they do moving together. So they all moving together because the phenomena of economic environment, that moment, okay? So if like this 2008, so anything, yeah, they're moving together. That's the phenomena we know. We're gonna learn in the theory, interpret, very good. Good observation, okay? So risk, should I say? Now we mentioned about default risk, right? So like I mentioned, like GE, it's you don't want to, if the government, the T-bond give you same yield as the GE bond, same maturity, if they all setting the par, the same coupon, nobody will want GE, okay? You have to give that compensation. The compensation means more, like I said, give you 7%. So this is 2% difference from treasury bond give you 5%. Yeah, I'm to go back again. That's numerical. I say, okay, here. I say is if this T-bond give you 5%, all right? So GE give you 7%. Okay, so the difference 7 minus 5 will be 2%. this 2% are called the compensation for your default risk. Okay, and it's called risk premium. Let's go there. So that's why, you know, the risk gave you compensation good enough now. So risk premium. Okay, so default risk. Why we have default risk? Because default, if the hold on, I said it this way. The bond, if you're a bond investor, you buy a bond means you lend money to the borrower, which is a corporation, for example, GE. They promise the legal document, the contract, writing very clear. They have to pay your coupon and pay your money back. Remember, you're lending $1,000. You don't want your money back. $1,000 is so important for you. It's your principal. So they have to pay the coupon and pay your face value of 1,000, for example. Then if GE say, I don't have money, they can file bankruptcy. That's the whole point bankruptcy come in. So once they file bankruptcy, they stop paying. So you could lose your payment of coupon and your principal. That's called default risk to you, because you imagine your $1,000 cannot get back anymore. And then some coupon payment. That's called default risk. You see how severe. If the bankruptcy announcement, you're losing so much. So default risk premium should compensate. It means the default risk premium have shown you they have high risk there. So this is called default risk. It means you cannot get your money back. Okay, they don't pay you anymore. That's a lot. Okay, but treasury bond don't have that condition. Like I say, treasury we consider we consider because we never, and our country, you know, GDP, like I mentioned before, remember we $20 trillion, $23 trillion GDP a year. So relatively we are a rich country. You look at the map, we are bigger than Europe. We're just one country bigger than Europe country. So we're a bigger country. We're very good, rich country actually. We just didn't manage it well. Okay. So anyway, so that's why always we think we can also our dollar, right? Our dollar is a settlement currency. So therefore we never have a chance to default. So we never default. Okay. So therefore we always can pay you back. So that's why you have treasury bond relatively safe. So don't have default risk, but everything else can be default. So therefore, you had to price in that high premium. I gave you 2%. Remember GE versus treasury bond 2%. That's called risk premium. So it's spread between the two interest rate. You know, so same maturity but different bond. Okay, so different yield. So that's why you know different bond, different yield. Okay, so that's the understanding. Okay, so this is a fun part. It's very interesting. I want you follow, okay? So respond to an increase in default risk on corporate bond. Just forget you read anything, just follow my lead. Let's say at this moment in time, we're expecting corporate bond going to default. We just like past 2008, we expecting the whole home mortgage are going to default. So if we expect the corporate bond going to default, are you going to want more corporate bond or less corporate bond?
Less.
Less. Very good. So you will dumping the corporate bond. So demand of corporate bond will shift to
the left.
Left. Very good. Shift left. Okay. So because the market in the equilibrium, okay, corporate bond, market in the equilibrium, demand and supply corporate bond is okay. Market in the price level in the P. Okay, in equilibrium. Suddenly, we find out could have default risk increased. People are very, very smart. In Wall Street, you had to be alert. So then you immediately dumping those corporate bond because the risk coming. So that's what called risk off. They all selling, just selling. So that means demand of the bond will shift to left. So when everything else there, just demand should like, look, price dropped. So corporate bond price dropped. What happened to corporate yield? My question is, what happened to corporate bond yield?
Yields went up.
Goes up.
Went up, yes, because bond price dropped, so yield going up. That's why it go to the roof, right? So that's why they're going up. Or price tank, okay, dropped. So remember, in Wall Street, also in financial market, money have to go somewhere, cannot put under mattress, right? $1 billion movement, sometimes even trillions a week or global. So where's the money do? Money had to go somewhere watching. if this is happening, default risk increase, people are selling corporate bond. What they do, look, they buying, this is a treasury bond, okay? This is treasury bond. So what happened to treasury bond? Demand.
Increases.
Increase, yes, increase. This is called flight to quality. Means selling the junk bond, selling the risky bond, go to quality bond. That's why when market like this is happening, sometimes the treasury bond will going up. So you can see demanding on treasury bond will shift to right. Okay. So what happened to the treasury bond price? Because demanding increase, so what happened to price?
Prices rise.
Decrease.
Price going up because think about it again, okay? Yeah, because many people buy bond, right? That's why demanding shift upward. Because if you want to buy, I want to buy, definitely will buy up the price, right? Market driven buy up the price, very good. So the shift to rightward. So therefore, price going up. So treasury bond will going up, corporate bond will be price dropped. So what happened to treasury bond yield?
Yields went down.
Yes, going down. Okay, so now treasury bond yields going down because the price going up. So you always follow the money price, then translate it to yield, easy for you to follow. Otherwise, you will be follow wrong direction. One moment yield, one moment price. What's going on here? You always follow the price because buy low, selling high. So now you know price going up, because money shift to buy corporate from corporate bond market to the treasury market, and then price going up in the treasury bond market. So then yield going down. So therefore, if you see 10 years yields going down, that means people buy treasury now, right? So that's the whole point. So that's what the responded to this corporate default risk increase. Okay, let me repeat again. Okay. So when market forecast or anticipate all have signal either way, okay, means credit quality increase, some risk coming, or you have one corporate bond drop a default showing your majority market have trouble. So then what happened? Fly to quality. People want a good one, so they drop. They selling all those lower quality bonds. So corporate bond will be dropped. Drop means the quantity demanding will drop. Nobody wanted it. So people are selling it if they have it. Okay. If we don't have, people don't want to buy. People have it, people want to sell it, get out of this market. So demand will shift to left, lower. So now you can see new equilibrium shift downward. So that's why price dropped. So the corporate bond price dropped, that means corporate yield going up. Okay. So that, like I said, if $1 billion money dropped, it must be put somewhere. You had to put a market. Normally, money never sleep. They don't put a cash. Nobody put money in cash, $1 billion cash. Let's remember opportunity cost. So they better than put it in the treasury, still make some money, safer. So that's why people are demanding on treasury bond. Okay, treasury bond is very popular and very liquid and a very demanding liquidity, very good. So okay, they buy treasury bond. So when they put the money shifted to treasury bond to safe, right, to safety, so that's demanding curve shift upward. Okay, so that's why price new equilibrium of the treasury bond are going to be PT, right? So this here increased from PT1 to PT2 increased. So now price increase of treasury bond, the yield of treasury bond dropped. Okay, so therefore, when you analyze the yield, you have to say how they come out. Why 10-year treasury yield like a couple of days ago going up? Yield going up, price dropped. It means nobody want treasury bond because people worried this inflation coming. People feel this is a bond market high for 10 years already. Okay, high enough going to be only going down. So people downplaying it. Okay, so yesterday market stabilized. Stock market very happy. Plus stock already tumble for end of month and period. So that's why March 1st is new month, and also they lower a lot. So that's why. But a lot of excuse there in that moment. Okay. So
Professor, basically people tend to be more risk averse, and so they follow wherever they go, the yield will be lower. Is that it?
it's whatever go, if you go to bond market, yes. If you go to bond market, whatever go, your money go chasing bond market, they buy the price higher, right? So that's it. Whatever we all buy GE bond price will going up, the GE yield will going down. So now in this case, we all the money we're selling it, we're going to buy treasury bond, then we buy up the price. Remember, phenomenon right now, people Wall Street trying to say is don't fight with the Fed. Why? Because when Fed want to buy treasury bond, why Fed want to buy treasury bond? Because they want to put the money in the economic system. You're gonna learn very soon. You're gonna learn when Fed put the money in economic system. It's not just tell you, say, oh, give you money. No, they will be use operation buy bond. When they buy bond, the money will go to the society. Okay, so when Fed want to buy a bond, of course, the Fed is the bigger buyer. So if you say the bond price won't go up, then it's impossible because Fed buy billions. You're gonna buy a couple of millions. So Fed want price going up, then price can go up because Fed use bigger money buy up. Okay, so if you buy up, then Fed buy up the price means yield going down, right? Remember, so yield going down. Yes, so that's a lot of Fed decision can trying to fight in this make the interest rate level. They can fight in any way they want to. So that's what the Fed, I say, don't fight it with the Fed. Okay. What do you mean bond multiply price and the yield? What do you mean? What do you want to say? Bond price, yield. What are you trying to say here? Remember, yield is year to maturity that yield. Remember, so I use a special moment talk year to maturity, and yield reflect the bond price reflect yield. So yield to mature, yield is mature, year to maturity. So that's how you use interpret each other. That's why a bond trader never say bond price. They just use yield. Say, hey, GE Corporation yield is 2%, let's say 5%. GM is 10%. Oh, the GM is junk bond. Then they analysis say good deal, not good deal. They say I want to go to GM, not go to GE because they give me high yield. Why? I want to go to take a risk because I may be thinking, let me go there. Because I may be thinking, well, within this 2 years, I just want to hold 2 years. 2 years, I don't believe GM going to default. Hypothetical, GM cannot be default, okay? That's a GM and the GE, okay? So that's they both corporate bond. That's a GE, I already use 5%, still 5%. That's a hypothetical. GM give you, let's say, 8%. And then I say, okay, 9%. I say, you know what? I want to holding this bond, GM bond. I want to go to high yield. I'm take the risk because I only hold in 2 years. I believe that within 2 years, GM cannot be default. Okay. In fact, GM won't be default. Okay, because GM right now is so good. Okay. So anyway, so that's how you take a risk high yield. So it depends on different view. You prefer, if you're so worried, you will go to treasury. So so that's why each person has different risk appetite, right? So some people can afford that thing. Okay, so we've done that. Okay, the rating. So now you know corporate bond. How do we know good or not good? Based on the rating. Okay, you know the AAA, then AAA is good, better than AA minus. Okay, so that's a lower level junk bond. Okay, so that's what you know based on rating. Traders also have to look at rating beyond that. Just one information, had to be others too. Okay, so next one. I'm not rushing, like I say. So I have 1 minute left. I think I just leave here. Next one also fun too. Okay, so risk structures. So anyway, let me mention. Okay, so I'm not settled down yet about which day is the midterm exam, but so far we decide at the 16th. Okay, depends on our schedule. If by couples class later, I will give you one class is review. Okay, we will mention more about the midterm. We're going to discuss it, but I want you to tell me, you say, I'm going to travel, I won't be there available. Tell me ahead of time. I don't want you last minute. Once I make announcement, nothing changed, okay? Because that's an announcement. We had to be fair to everybody. So that means once we make announcement, that means settle. So now I'm listening to you, hear from you about what are your concern, whether it's good or not good. What do you care? What are you thinking? So I'm listening. Okay, so you let me know if you don't agree. But so far it's between March 16 or March 23. Okay, so that's it. So we'll talk to you next time. Any question? All right, so that's it. Have a good night.
Thank you, Professor. Have a good night.